Welcome to vTalkInsight, Allocator's Lens Daily for December 6, 2025. We come into the week with equities near record highs, volatility subdued, and a Federal Reserve meeting where markets see a rate cut as almost guaranteed. Today matters for cross-asset allocators because that confidence is now fully embedded in pricing, even as labor data turns more fragile, global central banks diverge, and AI-driven investment reshapes credit and commodities. Let us start with how that backdrop is playing out in equities. In equities, the dominant feature is a powerful, broadening rally into year-end, even as policy uncertainty builds underneath. The S&P 500 has ground higher over the past week while the VIX has drifted into the mid-teens, and the Russell 2000 has printed record highs, reinforcing the idea of a classic Santa Claus rally. Leadership is no longer confined to the mega-cap AI complex. Small caps are enjoying renewed momentum as earnings expectations stay elevated and investors position for Fed easing, while cyclicals such as retail, banks, consumer lenders, and other reflation-sensitive names have taken the baton from semiconductors and the largest tech platforms. Valuations are rich, but earnings expectations provide an important offset. Forward projections see around 10% earnings growth in 2026, with growth broadening well beyond the so-called Magnificent Seven, and 9 major banks now project the S&P reaching roughly 7,500 by year-end, implying belief that profits rather than multiples will carry the market. Beneath the surface, though, the size debate remains unresolved. Small caps have surged to new highs and are highly geared to the prospect of a Fed cut next week and further moves next year, which would ease refinancing pressure on their more leveraged balance sheets. Yet a number of allocators still express a clear preference for large caps, citing better earnings visibility and concern that aggressive easing may not fully materialize. Corporate activity adds another layer of confidence and risk. The proposed multi-tens of billions of dollars Netflix acquisition of Warner Bros., financed partly with a record-sized bridge loan, exemplifies renewed appetite for large-scale M&A, but it also concentrates execution, leverage, and regulatory risk in a single very visible trade, just as Fed policy, labor data, and global geopolitics could challenge today's calm surface. For allocators, the key watch points in equities are the Fed's tone next week, the durability of this broadening leadership if cuts are less aggressive than priced, and whether earnings delivery in financials, industrials, utilities, and European names keeps pace with the optimism now embedded in index levels. Turning to rates, the front end of the curve is tightly anchored around a very dovish view of the Federal Reserve. Futures now imply a near certain 25 basis point cut at the upcoming meeting and at least one additional move in the first quarter, while market pricing and June Fed funds contracts embed roughly 2 cuts overall. The macro picture feeding that view is mixed rather than unequivocally soft. Core PCE inflation has eased to around 2.8% year-over-year, below expectations but still stuck above target. Consumer spending is growing at roughly 4.5% with GDP forecasts above 2%, yet job growth is stagnating, layoff announcements are running at their highest since 2009, and several ADP reports have turned negative. Against that backdrop, the 10-year Treasury yield in a 3.5% to 4% range looks consistent with trend growth near 2% and lingering inflation. And yields have actually risen this week in what could be the worst stretch for treasuries in 6 months, driven by conflicting data and a surge in corporate and sovereign issuance. Markets still anticipate a gradual steepening of the curve as policy rates fall while longer maturities remain pinned by term premium, housing implications, and fiscal dynamics, with some investors even seeing room for mortgage rates to retreat into the mid to high 5% range if 10-year yields stay contained. However, the balance of risks around the benign story is delicate. One large global bank now projects the Fed could keep rates on hold through 2026, a stark contrast with futures, and the pricing of a December cut and low terminal rate near 3% leaves little room for further dovish surprise, raising the odds of a hawkish market reaction if Chair Powell stresses data dependence or strong growth. At the same time, a likely step up in Bank of Japan rates toward a roughly 1% neutral level, and rising term premia in Europe amid political uncertainty and shifting issuance patterns, suggest global rate markets could deliver more volatility than the current selling of rate options implies. In credit, The tone is one of solid carry but increasingly demanding valuations and growing supply. High-yield spreads sit near their widest levels in roughly 15 years, offering headline compensation but also reflecting concern about weaker borrowers, while investment-grade spreads remain tight compared with history and, in some investors' eyes, offer less attractive risk-adjusted returns than equities given where equity volatility now trades. Supply is a central theme across the spectrum. Credit markets are absorbing heavy issuance from both treasuries and corporates, including funding for AI infrastructure, utilities and power projects, and large M&A such as the proposed Netflix-Warner transaction with its record-sized bridge loan, and several managers are trimming traditional investment-grade exposure where spreads are tight and issuance is relentless, rotating instead toward agency mortgages and select European credit where they see better relative value. The forward-looking risk is that this combination of tight spreads and abundant new debt leaves little cushion if growth or policy disappoint. Rising speculative-grade issuance could push spreads wider and compress excess returns next year, while regulatory actions, such as the SEC's move to block 3 times leveraged exchange-traded funds, underline a broader official concern about products that can amplify losses in a volatility shock. Credit investors are also watching highly leveraged, deal-intensive stories in streaming, airlines exposed to fuel and shutdown risks, and AI-related borrowers closely for any early signs that the present benign default backdrop may not last. Foreign exchange is increasingly where policy divergence is being expressed. With U.S. markets expecting cuts while the Bank of Japan is widely seen hiking in December and then moving gradually toward a neutral policy rate around 1%, the long-standing rate gap between the dollar and the yen is expected to narrow, and that shift could support at least a partial reversal of past yen weakness. Japanese authorities appear supportive of the central bank's autonomy to pursue normalization, which reduces political risk around further hikes and opens the door to higher domestic yields. That in turn sets up the prospect of some repatriation of Japanese capital from overseas markets back into JGBs, even if strong growth abroad limits how large those flows realistically become, and it intersects with a dollar that has already softened somewhat, a move that has helped international equities but is now pressuring export-heavy sectors in regions like Europe. Digital assets add a different flavor to the currency story. One of the largest spot Bitcoin exchange-traded funds has just recorded its biggest monthly outflow since launch, pointing to waning institutional appetite after a volatile year, yet at the same time CFTC approval for spot crypto trading on U.S. derivatives venues and progress toward broader market structure legislation suggest the asset class is slowly moving into a more regulated, onshore framework. For allocators, that mix of policy divergence, potential yen strength, a softer but still pivotal dollar, and evolving crypto regulation argues for close attention to currency as a driver of cross-border equity and bond returns around the upcoming Fed and Bank of Japan meetings. Commodities are reflecting both the AI investment boom and persistent demand for hedges. Copper prices have surged to record levels, supported by supply constraints, stockpiling ahead of data center and AI infrastructure build-outs, and uncertainty over potential U.S. import duties, and one major bank now projects prices could reach around $13,000 per ton by the second quarter, with a bull case average closer to $15,000 later in the year. Energy markets tell a more nuanced story. Oil has suffered a sharp drawdown this year on oversupply and weak Chinese demand, yet U.S. natural gas has climbed more than 40% and now trades at its highest levels since 2022, driven by a mix of colder weather, strong domestic demand, and rising power needs from AI and data centers, all while questions mount about future export capacity and the constraints of existing infrastructure. At the same time, U.S. shale producers are managing to keep oil output at record levels thanks to efficiency gains and deregulation, and utilities and independent power producers are increasingly being viewed less as defensive yield plays and more as growth proxies on the back of massive data center and grid investment. Precious metals round out the picture. Gold and silver have both delivered strong performance as investors respond to a weaker dollar, debate over using frozen Russian assets, and a broader shift toward a more multipolar and volatile geopolitical environment, and many portfolios are tilting toward gold rather than long-duration bonds as a hedge against both inflation and rate volatility. That sits alongside a gradual move away from traditional 60-40 frameworks toward more outcome-oriented mixes that dedicate explicit sleeves to growth, income, and diversifiers, with gold playing a larger role in the last category. Key watch points now are whether copper's strength eventually bleeds into inflation expectations, how natural gas and power prices evolve into winter, and whether ongoing geopolitical strains translate into further demand for precious metal hedges. Across assets, the message is that markets are leaning hard into a soft landing and orderly Fed easing, even as the underlying distribution of outcomes is widening. Equities are celebrating broadening earnings support and AI and M&A-driven growth. Rates are priced for a clean cutting cycle despite sticky core inflation and heavy issuance. Credit is financing that investment wave at increasingly tight spreads. Currencies are preparing for a world where the Fed eases while the Bank of Japan and others move the other way, and commodities are being pulled higher by industrial demand and hedging flows alike. For allocators, the next few weeks hinge on how the Fed balances labor softness against still resilient growth, whether Japanese and European policy shifts jolt global yields, and how credit and commodity markets absorb the continued surge in AI, energy, and defense-related capital spending. This video is for information only and is not investment advice. Visit and subscribe to vTalkInsight.com for latest interactive market insights.